Hey Bowtie Nation, Joseph Hogue here with what is quickly becoming the big bottleneck in the trillion-dollar AI spending theme, the new supply shortage building that is going to mean the best returns for the stocks involved. Those of you out there in the nation know we've been following another bottleneck in networking equipment stocks since late last year. Even after the most recent drop, shares of those stocks are way up. Old school Cisco and Arista Networks are up 35%. Astera Labs, ticker ALAB, is up 63%. And favorite Broadcom, AVGO, is up 100% in the last year. But now another group of stocks is becoming the next bottleneck, an even bigger supply shock that could mean bigger returns, and I'm highlighting 5 stocks to buy in this new gold rush. Analysts at Wells Fargo estimate electricity demand from AI could jump almost 100 times through 2030 as those data centers become the demand source for global power. And nation, this graph is in terawatt hours, so just 1 terawatt hour is 1,000 gigawatts, which is enough electricity to power 700,000 homes for a year. So you see what kind of giant increase this is in power consumption. Now, right now, the US electrical grid delivers about 3,800 terawatt hours. That's to 162 million customers a year. That is 7,000 power plants, 642,000 miles of high voltage lines, and decades in the making. But now, besides the billions of dollars in costs, you immediately see the problem with this timeline for sources of power supply and the mismatch with data center construction. At the bottom here, you see it takes 2 to 3 years for planning, permitting, and construction of data centers, but none of the potential power sources can be ready in that time. Here, you're looking at least 3 to 5 years for inverted-based sources of power, which are often that intermittent and not dependable for a data center. For the traditional transmission infrastructure, it can take up to 10 years. In fact, this is already becoming an energy crisis for property managers. In a survey by real estate firm Prologis, 89% of supply chain managers said they had already run into an energy-related disruption in the last year. This energy is the new fault line in the global supply chain. Nation, there is a gold rush going on for electrical infrastructure. Companies in the space are backlogged on projects years in advance, creating tens of billions of dollars in cash flow. And these stocks have already started higher, but as that data center boom develops, the demand is only going to increase, and I found 5 stocks you want to be buying right now. First up here is Quanta Services, ticker PWR, a contractor for transmission and substation buildouts, so building out that traditional electrical grid infrastructure. Quanta is the market leader in this utility, renewable technology, and energy infrastructure industry, seeing 83% of its revenues coming from this core area, the utility, power, and technology and manufacturing customers. Within its 2025 revenue growth outlook, you can see what kind of an effect this data center buildout is having on it. 100 to 105% growth in this technology and load centers buildout. These are large, multi-year build programs, especially in that data center market, and meaningfully expanding Quanta's addressable market. And in fact, Quanta just reported its largest backlog in history, more than $39 billion in backlogged orders, $22 billion just for the next 12 months, so $22.3 billion just in the next 12 months revenue from backlogged orders, more than 10% growth just from the past 3 months. Now, for each of these stocks, I want to go through the revenue growth and the valuations just to kind of get a comparison of where these are sitting at. Here we see Quanta Services, ticker PWR, again, expected to post 18% revenue growth this year, expected to slow down to 13% next year. I think that is underestimating this growth, folks. We just saw that they have more than $23 billion in backlogged revenue just over the next year. I think that number grows with that data center build out. I think they get a lot higher than that 13% growth here over the next year. But even this, 18% this year, 13% plus next year in revenue growth. And on the valuation measures here, we see 2.3 times on a price to sales. Now that is higher than it has traded at in the past. We can see here over the past year, it's traded as low as 1.6 times. So a little bit more expensive than it is in the past, but I think very much a good value target here within the electrical and energy infrastructure space, especially compared to some of these other AI related stocks that are trading at 10 and 20 plus times on a price to sales basis. So 2.37 times on a price to sales. Therefore, Quanta Services, that is the market cap, so the total value of all the shares in the market divided by the sales, the revenue. And when you've got a company growing revenue by 18, 15% a year, then that number quickly becomes justified. 2.3 times price to sales valuation here. Keep that in mind when we're looking at some of these other stocks, kind of get a feel for which ones are your value plays in this space. We've also got Constellation Energy Corporation, ticker CEG, up 52% just over the year to date right here, even after this recent sell off in AI related stocks. Now, CEG is the US largest nuclear operation, and with the Trump administration becoming very favorable to nuclear against all the other alternative sources, including support of $80 billion in new nuclear reactors. We are seeing rare bipartisan support for production tax credits for nuclear energy in comparison with some of those other alternatives like solar, like wind, where the administration has gone back against those. And on this, we see management estimates it can drive at least 13% annualized growth on its earnings through 2030. So 5 years, a huge step up in earnings through that period on this trend. Growth is expected to be a little bit slower on the revenue side here at just 5% this year, 6.5% next year. Again, I think a lot of these estimates are underestimating the importance and the supply bottleneck, the supply disruption in this electrical space, and what these companies are going to get out of it. Now, Constellation Energy and that nuclear energy theme, it does take longer to build these out, especially with permitting and planning. So we are going to see a lot. This is going to be factored in a lot towards the end of that 5 year period, towards 2030. So I think this revenue growth does increase over years, but it will take a little bit longer than maybe some of these other companies. And Constellation trading a little bit more expensive here on a price to sales ratio, that 4.3 times. Again, this is quite a bit more expensive than it has traded in the past. 2.7 times there over the past year, the low there in March of this year. So this one is quite a bit more on the expensive side if you compare it against its past as well as against some of these other stocks. So I would look for maybe a pullback in Constellation before really loading up on the shares. And here, First Solar, ticker FSLR, the only solar stock on the list, one of the larger solar stocks of their $27 billion market cap. And I know most solar stocks have gotten hammered over the last year. First Solar, though, up 41% this year on this theme. It is the only US headquartered solar technology and manufacturing company. So obviously that manufacturing idea here in the US, it is helping it here with this stock. It booked 3.6 gigawatts in total production just over the last quarter. So this is a large scale energy production company that can deliver that energy. It's got facility buildouts in Louisiana and Alabama. So if any solar company can get through this government, it is FSLR. Now, looking through these stocks, you always want to look for that backlog of orders, the booking opportunities here on just under 3 gigawatts of bookings per quarter here. There's a lot of runway to go to that 18 gigawatts to mid and late stage opportunities. Okay, 18 gigawatt opportunity in booking here in revenue just in North America, India, and Europe. It's 3 main segments here. So that is a lot of production growth that can help support this 20% revenue growth estimates this year and next. I believe that goes on through 2030. So 20% revenue growth a year. We see here with earnings expected up as high as $22 per share over the next year into 2026. Now, if we take that valuation there, $248 a share right now, divided by that $22 per share, that is very quickly becoming a 10 PE stock, okay? Price to earnings of just 10, very low valuation for a stock growing at 20 and 21% annualized revenue growth. And here we do see those valuation metrics here a little bit higher on the price to sales, 5.4 times price to sales. Again, just like a lot of these other stocks, trading much more expensively than it has in the past, traded as low as 3.2 times price to sales there in March of this year when that the tariff sell off came and took a lot of these stocks down, but it did trade as high as 7 times last year. So this one does have some multiple expansion. It can run into 19 times right now on a trailing price to earnings basis. But we saw with that earnings growth expected, this comes down to about 10 times price to earnings very quickly and would be about as low as this thing is traded at over the last year. So I think this one could go up double and it would still be within that range that it's traded at over the last year as far as these valuation metrics. And here we have Bloom Energy Corporation, ticker BE, up 371% just in this year to date here. Bloom is the custom-made stock for data center theme and its on-site solutions converting natural gas to electricity. Okay, these solid oxide fuel cells convert the gas into electricity without combustion. So it's much safer. It can be co-located right next to the data center and it can be scaled up to megawatts on delivery. Now, looking back on that timeline that we looked at before, Bloom is the on-demand solution, with the company recently signing a giant deal with Oracle to deliver on-site power to data centers in as little as 90 days, years faster than those traditional sources. Bloom is already at 1,200 sites globally, deploying 1.5 gigawatts of global energy and has grown revenue by 51% over the last 3 years. And here we see the fastest revenue growth of the group, 29% revenue growth expected this year, down to 28% next year. Again, I think these numbers keep on going through 2030 as we saw that data center build out theme is just going to create a bigger and bigger bottleneck in these energy services. This demand for energy, Bloom can co-locate these services within 90 days. So it's going to be the go-to leader here for energy production at data centers. Understand though, you're going to be paying for that kind of growth. 13.6 on a price to sales valuation there, way higher than the 3 times price to sales it traded at there in March, even higher than it's traded at over the past year. But you got to go where the growth is, folks. So I think I probably defer to some of these other energy stocks here, here with a lower price to sales, a lower price to earnings valuation for most of my portfolio, but then have some exposure to Bloom Energy because it is the custom-made solution for this data center theme. But then, nation, understand you cannot just invest in any AI-related energy name. Okay, I warned against Oklo and Fermi in October, surging stocks, but on revenue that isn't going to even appear for years, and showed you how to use put options on Oklo to protect your portfolio against any AI sell-off. And those Oklo put options at the $50 strike price that we bought for $8 each in October there are now worth over $11 per share for a 37% return in less than 4 weeks and have been a huge protection against this recent sell-off in my portfolio. Now I want to get to our next stock to buy in this theme, but you need to be using option strategies to not just boost your returns, but as we saw there, also to protect your money. To help you get started, check out the link in the description to our Ultimate Options course. That's over 3 hours of video. I'm going to start you with the basics and walk you through all 29 option strategies, when to use each, and how to set it up, including real-world examples with shares of Tesla. The course also comes with a one-of-a-kind strategy finder to help you find the right option strategy and an options calculator to show you exactly what to expect. Now, right now, I'm relaunching the course at a 38% discount. Save $150 off, but only for the next 3 days. You're going to get all the basics to get you started, the strategy finder to make sure you're using the best strategy, the options calculator to show you exactly how much money you can make, walkthroughs on all 29 strategies, and a 14-day money-back guarantee. And that $150 launch discount is only available with the coupon code I'll leave in the description below, so check that out or just scan the QR code here. Now back to those stocks to buy though, and as we saw with Bloom here, natural gas is quickly becoming the fuel of choice for data center power. It's relatively cheap, it can be co-located with generators at the data centers quickly and safely, and the US is swimming in gas production. And that is going to benefit Expand Energy, ticker EXE. That's last year's combination of Southwestern and Chesapeake Energy to create the nation's largest natural gas producer, 7 billion cubic feet of oil equivalent per day in 2025. That is huge production in 3 major areas within the United States. Folks, this has the flexibility and the growth there that we want in natural gas. Besides just this data center build out, we also saw that $750 billion promise by the EU for energy exports from the US. And of course, here we see in the revenue growth, we do see the 183% revenue growth that is just basically a part of that combination between Southwestern and Chesapeake. So organically, it did not grow revenue by 183% over the last year, but it is still expected to grow revenue by 14% over the next year to $9.6 billion. Earnings are expected up to almost $10 per share here for this company. So again, if you just look at the growth, the forecasted growth here in the stock, $115 per share right now, up to about $10 per share in earnings over the next year. That is about 11 times price to earnings. So it is quickly becoming a value stock, but with a growth stock growth rate here in its revenues. And looking at the valuation statistics, we see some of the lowest valuations here in our group of five, price to sales of just 2.5 times. It's traded much higher than that, 4 times over the past year. So this is actually one of the stocks that is trading below its valuation multiples or its averages over the last year. So definitely a stock you want to include in your portfolio, not just for that data center, not just in that data center theme, but in that entire energy independence theme as well. Get your $150 coupon and start using options to boost returns, protect your money, and create income with our Ultimate Options course. Everything you need to get started and a 14-day money-back guarantee with the link below. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.